3, 2, 1. We're back.
Alrighty, we are back.
Well, you're back. I've been back. I've been here the whole time.
Yeah, you know, I feel like I haven't gotten much of a tan for spending a month, not really at the beach. I mean,
Yeah.
it's
Near
hot
the
up
water.
there, near the water. But
Yeah.
I'm not
I
much
never
of a.
find myself laying out.
No, I'm not much of a layout kind of guy.
I don't know how people do it, honestly. Like, we're planning that Key West vacation in next spring, right?
Right.
And everybody talks about going by the pool and laying out. I'm like,
no.
why would I just lay here by the pool in Key West? Like, there's
right.
other stuff to do.
Lots to do in Key West.
Yeah, mostly revolves around bar hopping, but that's okay.
Yeah, it's okay.
We need a
couple
few
days. That's all right.
brain cells gone.
Probably.
What do you got for us, man?
Dude, it's the second down week in a row.
Yeah.
Nowhere near as bad as last week.
Mhm.
Lots happened this week. A lot of inflation reports, CPI and PPI. Market was jumping all over the place, and so very, very tough to. We talk about it all the time. You can't day trade your TSP.
Yeah.
Depending on which day of the week, which time of the day you looked at the market, we could have been way up or way down.
Yeah.
The volatility.
And unfortunately, the closing price is all that matters, right? I mean, and by then, you can't make that trade. You got to make the trade tomorrow. Well, what's tomorrow bring? I don't know.
Right.
It's constant battle. And, as we say often, you can't day trade it, right? You can't sit there and toil over the ups and downs of the day. You really have to take it on a weekly basis, which is what we generally do. I mean, we do look at it every day because that's our job. Right. But when you're managing this thing, you have to look. You have to be able to go in and out. And if you stay in too much, you're just going to drive yourself nuts.
The other thing I'm going to talk about in the newsletter is the difference between when the market goes down because everything's going down, or when the market goes down because, some sectors. So tech, consumer discretionary, and communications, communication services, have been the three sectors of the S&P 500 that have been driving the market higher, right? Really, definitely since the beginning of the year, since December of last year, really. So if this week or last week we had seen all 11 sectors in the S&P like down big, that's the whole market rolling over, and we're not seeing that. So it's sector rotation, right? Tech, consumer discretionaries are coming down, but the energy is way up. Some of the other sectors are kind of starting to take the lead. Industrials is actually at new highs, so. What that basically translates into is, yes, we're having a little bit of a correction here, but the market is not collapsing.
Right.
And so if you only get 2 moves a month in TSP, it helps to know whether or not you're in a condition where the market is falling or there's sector rotation going on. And that's going to be a big part of the newsletter. So if you're a subscriber, definitely want to check that out, because that will tell you whether or not this is a thing that you want to weather through, or you want to get out.
And it has to do. Some of this has to do with risk tolerance. Some of it has to do with perspective, right? So, if you have $1 million in your retirement account and the market goes down 1%, how much did you just lose?
$10,000.
$10,000. $10,000 to me is a lot of money.
Yeah.
Even if I have $1 million. So that's if that's how you are grading yourself and managing your retirement account, it's going to be maddening. It's going to hurt, because there's no way, given the restrictions we have within TSP, not to take a little on either side, right? A little, you're going to get a little up,
right?
Meaning you're going to get in a little late, you're going to get out a little late. There's no way to do that without guessing, right? Because you have to wait for the trend to change. So if you're not willing to lose an opportunity of about 1 to 3%, you're not going to be able to play this game. You're not going to be able to manage it actively in a TSP, because there's no way not to take that. Now, what we're trying to not take is that 10%, that 30%, those big ones, the ones that took a decade to get back. Right. Like, those are the ones that we're trying to fight against. There's absolutely no way that if there is a way, and you guys know a way that we don't know, please tell us, because with 2 moves a month, you'd just be guessing, and then you would use your move, and you might be sitting on the sidelines, or you might be in and you want to be out. You can always get out, but anyway, the point is that it's all about perspective. So if I have $1 million in my account and I lose 1%, that's a lot of money. If I have 100,000 in my account, okay, maybe that's not as much money, but it's still just it's at the end of the day, it's still 1%, and that's what you have to focus on, right?
Yeah, if you can't lose 1%, then you can't be in when the market goes up 3, 4, 5%, because you can't.
Yeah.
I mean, you could do it if you could day trade it, but you can't.
Right. Yeah. Oh, it all changes if we have more moves,
right?
And but we don't.
Yeah.
It's the restrictions of the TSP.
So actually, that's going to kind of lead into a couple things we're doing here. So we got a question about the podcast from, I think it was 2 weeks ago. July 30th. Then we had another question about, really completely different from TSP, but like, are there some high yield options that if you had money outside of TSP, if you think the market's going to go down from here, what are some of the high yield options that are available? Because yields are relatively high right now. And so we'll talk through some of that. Tesla is the bonus chart, and then the weekly TSP funds. Okay. So we got this question, says in last week's video, and they were talking about the July 30th podcast. You addressed the question posed by a member whether it was time to move to the G fund. I was very pleased that it was asked because I was contemplating the same thing myself. I know that historically August is never a good month for equity. So let's just take that part of the question first. You can get this from stockcharts.com. It's part of their free chart, so I'm pretty sure anybody can get it. You don't have to have a subscription. You can adjust the number of years that we're talking about, but I went to the maximum, which is 20 years. So what it's telling you is the percent of months in which the SPY, which is our C fund, closed higher than it opened. Okay, so it's the whole month. So from 2004 to 2023, so 20 years, August closed higher than it opened 60% of the time. So to say that August is always, seasonality is a thing. There's no doubt about it. That's why they say the best 6 months of the year are November through April. 1, 2, 3, 4, 5, 6, November through April for the S&P 500 and the Dow Jones Industrial Average tend to be the best 6 months. And it makes sense because these are the ones that, January is the worst, but of the 6 months, these are the best. August is one of the worst, but still to say that August is always a bad month, or however it was worded, is not true, because it finishes higher 60% of the time. So this is good information. There are obviously years when April and November are down months. But if you were going to, roll the dice on it, 80% of the time, April is an up month. So if you're managing your TSP based on historical odds, you would just be in the C fund during the month of April and the month of November, or not just, you would just be in those months, but you would expect to make gains those months, right? And May and July. Because over a 20-year period, those are the most likely months that in this case, what it's saying is it closed higher than it opened. So you get the idea. To say that August is always a down month, it's up 60% of the time. Okay. The email question that this one's referring to, it said, I read your article. This is the newsletter back on July 23rd. I feel like the market will pull back. And that's what we were addressing in the show, right? I feel like the market will pull back. That the term I feel like I feel like the market, it makes me cringe, because I feel like the market's going to do a lot of things too, but if I don't use technical analysis as guide rails, I'm guessing. And especially given you have to have your move in by noon to get that day's closing price, and you only get 2 moves a month. I mean, the 2 move a month move is general. You can do more than 2 moves a month, but to trade it based on feeling is definitely not what we're looking at doing. So, and the second part of that is he's saying, I've been in the S fund since November 2021. I moved to the G fund today, July 24th is when he moved to the G fund. Okay, so let's just kind of backtrack through that for a little bit. So we talked about the feeling of it is not a great way to do it. And we're talking about the S fund. If you've been in the S fund since November 2021 and you moved to the G fund on July 24th, 2023, this is what it looked like. Okay. So here's November 1st, 2021. So let's say you got into the S fund right there. You took the entire 2022 decline, which was like 37% on the S fund. And what we're talking about, to answer that one question, was since then, the retracement up to, he said, the 24th of July, right? If you lost this much, that loss is the wrong word, but the drawdown, 37% drawdown, you gained back that much. Okay, so maybe a third of the down move, right? It's not half. Say it's a third of that down move. If you made that back and you're concerned that the market's going to roll over and you want to move to the G fund, that's fine. You've made back a third. If you can sleep better at night because you think the market's going to roll over, that's great. What actually happened after the 24th is the market kept going higher, right? Now, it has subsequently rolled over this in the last 2 weeks, which is kind of, prescient for this guy. But on the 24th of July, the market had pulled back for a couple days, and then it continued to go higher. And could it have continued to go higher? Sure. The fact that it didn't and rolled over a little bit is beside the point. It's you're getting out at this point for an emotional reason. And so that's what we were talking about to relate to that question. Okay. So the other part of it, your explanation was a bit conflicting to me because you stated that smart money was in cash, your rationale was reasonable, so I did not reallocate. My action cost me $10,000. I don't know what to say about that.
Which, by the way, I was using $10,000 because it was an easy round number. I wasn't referring to this, but it is the similar circumstance, right?
Right.
Yeah. I
mean, if you think that the market is going to roll over and you want to reallocate to the G fund, there's nothing wrong with that. All we're saying is technical analysis provides guideline or guardrails really, but to use it you have to allow for some movement. And so the biggest thing really about this is if your come from is I lost or it cost me $10,000, you are not looking at the trend. You're looking at your account balance, and you can do that. I don't know how you would ever stay in if you're always looking. If you're always worried about losing money, how could you ever be in to make money? I just.
Yeah, I mean, it's, we also say that we use our account balance as our performance indicator, not our rate of return, right?
Right.
A lot of times, right? Do we care about rate of return? Absolutely. It's a performance indicator. But that's not what I look at is my account going down or up? So it does matter that it's going down. It's just perspective.
Yeah.
Again, I don't know how much this person has in their account. If they have $1 million, $10,000, okay, it's relative. It's
sure.
1%.
1%. Yeah.
If they have $100,000 and they lost $10,000, well, that's a pretty big.
That's different.
But I don't think the market went down 10%.
No.
So I don't think that's what happened, right? So that it's about perspective, and and again, if you're the person that sent in this question, this isn't. Hopefully, it's not coming across negative, because what we're really trying to get. It's a great question, by the way.
Yeah, it's a very good
It's
question.
great input, because this allows us to talk about things, on the show. That if there's one person thinking this, I always think, well, there's got to be at least 10 or 100 other ones that are thinking the same thing, and so again, all about perspective. What was the percentage loss or gain? And if you're not willing to absorb that either way, on your way in or out, active management is probably not for you.
Yeah, right.
It just probably isn't, right? And if you want to be a passive investor, and otherwise known as buy and hold, and the market is trending up for a long time, you're going to fare very well.
Yep.
If, as it has in certain times over the decades, gone down significantly, you will also pay that price, and you have to be willing to accept that. So it's just luck, right? And so if you can't stomach these kinds of ups and downs a little bit, the wiggle room, the corrections,
right,
all these things that we talk about all the time, active management may not be for you. If you guys haven't read our ebook, we discussed that. The first thing you have to do as an investor is figure out, are you passive or active? Mm-hmm. Then you want to think about your risk tolerance. You have to figure all these things out before you start to get in the investment game. And that's whether it's a TSP or anything else. If you're
right,
buying, investment properties, if you're doing anything, you got to start with, am I active or passive? What's my risk tolerance? What's my circumstances? You do that for yourself to know where you're going to be comfortable at. And then, when we talk about the TSP, we've got these restrictions. And so your hands are tied, and you got to accept it.
Yeah. There's the 2 move a month rule and the noon rule make it very difficult, which is really why it's better to look at the charts on a weekly basis. The problem becomes when you get so far above that 20-week moving average line that, on a percentage basis and certainly a dollar value basis, if you have a lot in your account, you're going to see a drawdown before you get to that support level where you have to make a decision.
Yeah, that makes it really difficult. I mean, we talked about that was the last week, where we're so far away from. So we use, we look at all sorts of systems, right? And we're always looking at this stuff, and we want to get better at it, as anybody would want to. And so, but some of these things are just like, there's only so much you can do, right? Especially considering that you can't make a move before you're really ready to make a move, because you got no more moves left, right? So you got the 2 moves, and I know we keep harping on that, but it's very important to realize why that's so much different than operating in a brokerage account or an IRA or anything else, right? Where you could come out and wait out a few days and see where the trend goes and come back in, and you can do that stuff. We don't have that luxury. So, when Jerry's talking about, I don't know if you have the chart showing that, how far off we are from the
we will. We'll get
at the end, right?
Yeah.
And so when we come to that chart, guys, look and see what we're talking about. But basically, we're so far above that moving average, and you say, okay, we'll change the moving average. Sure. So we can zoom in, and that is what we do, right? So we see, but that doesn't change the fact that you can't be in and out. So if you did it by the closest moving average, and you're in and you're out and you're in and you're out, hey, that'd be great, but you can't do that.
Right.
So when we're that far off the moving average, we're going to have to accept some, quote unquote loss to figure out if there's a real trend change.
I mean, last week we did a chart. I don't have it. We did it last week on the show. It was a 3-year S&P 500, and we did 5 reallocations, I think it was, since the bottom in COVID on a weekly basis. If you had just followed strictly by the stack that we use. So if you want to know the methodology, the exact methodology, basically almost exactly that we use, it's in last week's show. And if you do it on a weekly basis, you had 5 reallocations, and you caught all of them move in the last half of 2020 after the recovery from COVID, all of them move in 21. You got out the first big down week in January 22. You were out of the market almost all of 22, and then you were back in, I think it was November of 23, and you'd still be in. And so, but within that, there are some drawdowns. You got the majority of those up moves, you were protected from the majority of the down moves, but there are definitely some drawdowns that you have to be able to stomach in there. All right. So the other question is about smart money. Are there indicators and that kind of thing? So here's some of the smart money slides that we looked at last week. So J.C. Peretz, we talk about him all the time. What he's saying here is smart money is out of the market. They're in cash, right? So, but he's kind of making fun of it because he's saying after the greatest first half of the year in the history of the NASDAQ, the sell side analysts respond with their most bearish second half outlook on record, right? So he's saying when the first half, well, we're going to get to a graph of this in a couple slides, but given that where we had the best first half of the year for the NASDAQ in history, the smart money is doubling down on this idea that the second half is going to be really bad. So smart money is in cash, okay?
No, that's just a term, by the way, right?
Yeah.
So that doesn't mean that we're saying it's smart money.
Right.
That's just kind of a generic term that people use for like institutional money, high net worth, those kind of people, smart money, meaning people that do this for a living. It doesn't mean they're right. And that's kind of what he's making fun of. Right. He's like, all the smart money, quotation marks, is doing X, Y, and Z. So maybe that just came across, different when we say it that way if you don't put it in context. I don't know. But that doesn't necessarily mean they're smart. It just means that that's what everybody else is doing kind of thing, right? And that's actually getting less and less true because with everyone having so much information at their fingertips, my feeling towards this is that I see smart money, institutional money, high net worth people starting to react a lot like retail investors because we all have the same inputs, right? Used to, not everybody read the Wall Street Journal. Not everybody had a subscription to Barron's, right? The average folks were not looking at that, right? Now you just flip on the TV and there's Bloomberg and there's CNBC and there's Yahoo Finance and there's all this stuff that you can get those inputs and they're all fighting for time. So anyway, the point is we're all getting a lot of the same information, and so sometimes there's conflicts and sometimes there's groupthink, and I just think it kind of changed the landscape. Whereas used to, whatever smart money was doing is because they had access to information we didn't have. Right. And that's not necessarily the case anymore.
Right. That is true. Technology has definitely leveled the playing field as far as that goes. And JC talks about it, and other people talk about it all the time. It's much easier to be a retail investor than it is to be an institutional investor. And institutions are the smart money, right? If you're an institutional investor, you're trying to buy and sell big blocks of shares, and you have to look forward. You have to use much more macroeconomic rather than technical analysis. You have to look where you think which sectors of the economy are going to be moving next quarter and buy into that on what you expect to be happening going forward. That is not what you have to do as a retail investor. And so people say, so that's the one side of smart money. Other side of smart money is money managers. So not like your financial planner that puts you in a high risk, low risk, medium risk fund, and you take whatever you get for the year, and then you go come back and look at it. I'm talking about money managers that actually manage money, right? If you are a money manager for, like, say, a pension fund, and you have been bearish, you haven't thought that this rally that we've been in since October of last year is real. You're not investing in that. And so you are down relative to your benchmarks. And at some point, you have to start getting on board with this rally, right? Now you're way behind, and you're looking at it, and it can cost you your job at the end of the year. I mean, you can't be that far behind the benchmarks, behind everybody else. So you and you can't make that money in bonds, right? So what are you going to do if you're 9 months into this thing and you haven't enjoyed any of this rally, right? Now, given the rally has been mostly 7 or 8 stocks, right? So it would be fiduciarily irresponsible if you're a money manager, to put your clients in, the mega cap stocks only, which are the ones that drove this whole rally.
Right, so just to catch up.
Just to catch up. Those guys are in a trick bag, right? But they are also in the category of smart money. So now, as this rally keeps going and those guys start piling in, it's going to look like smart money got in at the wrong time. And this chart actually is a pretty good depiction of that, right? Since February 22, which is pretty much the top of the market, smart money has been decreasing I'm kind of extrapolating out of this, but the question here was, are you more likely to increase or decrease equity exposure over the coming days and weeks? As of like the end of July, I think this is JP Morgan's fund managers. It's the lowest that they were likely to add exposure to equities. And that's sort of fine if you think right now we're at a top, but they have been lowering all the way in. I mean, they haven't been participating in this rally. So how smart is that money, right? And here's kind of the kicker of it. And you can I kind of poked at this both ways last week, but the first 136 trading days of the year, right? So this is the S&P 500 best performance through the first half of the year from 1928, right? It's almost 100 years, 1928 to 2023. When the first half of the year is really strong, the full calendar year tends to be very, very strong, right? The only exception, well, not the only exception because we did it. Well, yeah, it's the only exception for a negative year was 1929. You had a really strong first half and a really bad second half, so you had a negative for the year. But every other year, right, this is the top 15 years in performance. And so we are in 11th place right now, right, for over the past 100 years. So it's very likely that we finish the year in the green. The only example, ironically, is number 12, which was 1929. So, but the bottom line is, the quote unquote smart money should have looked at if the best performing first half of the year tends to translate into best performing full year, and they're not participating. Okay, and that's not a timing issue, right? This is stuff that you have to think about for how you want to allocate and kind of manage your TSP. But we're not talking about, day to day, reallocation decisions, right? That's not what we're talking about here. All right. Anything else you want to, I didn't do any kind of transition slide. So yeah. Hopefully that answers that question. And the ebook is, if you haven't read the ebook, that is definitely the place to start if you want to get an idea of like how our methodology and really it lays out really well our come from in terms of managing TSP.
Yeah, and I'm not sure there's a link on the current website to go directly to the ebook anymore. We used to have those pop-up things, and they were annoying, so we got rid of them. But if you want to find it and you haven't, you just go to growmytsp.com /ebook. /ebook, and you can get it. So
okay. All right. So the next question. So this is a pretty good one. On one of your Sunday night shows, could you please go over things like high interest savings accounts, CDs, savings bonds, things like that? With interest rates being so high, that might be a safer alternative than the stock market. Yes, it certainly could be. I know it isn't exactly TSP, but there are probably a lot of people interested in other options to invest their money. Yes, a lot of talk about bonds this year. We talk about it tangentially, basically, every week because the F fund is our bond fund. And so we're going to get into that in a little bit. But when people talk about CDs and high yield savings accounts and things like that, they're talking about the short rate, not the long rate. So 2-year treasuries and shorter, right? If you're talking about 20, 30-year treasury bonds, that's a different part of the yield curve, and it acts in a different way. So at some point, we are going to talk about that because that will affect the F fund. But for this one right now, what we're talking about is what to do with your money on a short term, okay? So jumbo, in this case, I got this from Investopedia. It's pretty current because it's for August 2023. What are the best jumbo CD rates for August 2023? So jumbo basically means you have to buy $50,000 to $100,000 worth of CDs. And what you would expect is if you buy a CD, you are locking up your money. You're giving the bank, in this case, it's a jumbo CD. Say it's $100,000. You're giving it to them for a relatively short time in a CD, but you're locking up that money. So, okay. Annual percentage yields listed below, up to date. Okay, so for savers who want to sock away $100,000 or more in virtually risk-free investment, so it is risk-free. It's not virtually. It's risk-free. Jumbo CDs offer a return that's both safe and predictable, if modest. Okay, so we'll show what those are. To help you earn as much as you can, you've done the research to find the best, or we've done the research to find the best nationally available jumbo CDs, culled from more than 50 banks, credit unions that offer jumbo CDs nationwide. So if you want to find the actual banks, just go to the link. But I didn't list all the banks that are available. But there's a couple things I wanted to talk about that. So today's CD rates are higher than we've seen in more than 15 years, pushed up by the Federal Reserve's rate hike campaign that began in March 2022 to tame inflation. So CDs are, like I said, part of the short-term yield curve, and that's what is affected when the Fed raises or lowers rates. So with another increase announced in July, the Fed has hiked the Fed funds rate to a cumulative 5.25%. CD rates closely follow the Fed funds rate, so will likely trend slightly higher. If there are more Fed increases this year, which I think it's questionable whether or not in November the Fed raises rates, but that could push rates even higher. So to aid in your decision, like we said, they ranked the best jumbo CDs on this list. CD shoppers should be aware as certificates with jumbo in their name aren't always the most lucrative option. As shown here, sometimes you can do better with opening a non-jumbo, so not putting in 50 to 100 grand, and simply putting in a jumbo-sized deposit onto it. So this is what I kind of wanted to show. So this is the time horizon that your money is locked up. Okay, so if you buy a CD, if you buy a 3-month CD, your money is only locked up for 3 months, right? All these percentage rates are annualized. So if you buy a 3-month CD, this is in the orange top national jumbo CD rate. So you have to contribute 50 to 100,000, and in the purple there is the top national regular CD rate. So that's if you want to do a couple thousand or whatever. So 3 months. If you buy 3-month CDs, jumbo, you're getting 5.2% annualized. So it's not like you're going to get 5.2% rate of return over 3 months. That would be what it would be if you owned it for a year. Okay. 6 months, which makes sense that it would be a little bit more because you're locking up your money for a longer period of time, right? The strange thing, and this is what I was kind of trying to get across, because this is the inverted yield curve. You would think that if you lock up your money for 5 years, you would get a better rate of return than if you locked up your money for only 3 months, right? Bonds, the way the natural yield curve is supposed to be, if you lock up the longer you lock up your money, the higher rate of return you should get. In this case, it's backwards, right? As the amount of time you're locking up your money increases, the percentage that you're getting is decreasing, and that's because we have an inverted yield curve right now. So what people are doing, say you do anywhere between 3 months and 1 year, you buy a CD. Say the 1 year, you buy a CD, so you've locked your money up for a year. You're going to get somewhere 5.5 to 5.75%, but your money's locked up. Okay, so that's how CDs work. You're kind of loaning your money to the bank. The other thing that you can do, G fund first. So for our purposes in TSP, this is what the rate of return, has been for the G fund year to date in 2023, 2.26%. So if you extrapolate that out to the end of the year, you're going to be about 4.5%, let's say, if you stayed in the G fund for the whole year. So, which, isn't terrible if 2023 was a down year. I mean, if you were in the G fund in 2022 and you got, even if this was only 3% for the full year, that would have been great because the market was down 20-something%, which is why we only use the G fund as a tool and not as an actual place to park your money for a long time. But the other thing you can do besides CDs is actually buying the bond. So this is a 2-year government bond yield. Okay, so when yield goes down, the price of the bond goes up. Okay, so this is going back to 1989. You could have bought a 2-year bond that was giving you a 10% rate of return. Okay, so you buy this 2-year bond, let's say in 1989, at 10%. So you put $1,000 in this 2-year bond. Let's say you buy $1,000 worth of this bond. As yield comes down, the price of that bond goes up. So you could have bought it, you're getting 10% rate of return, and then it's only 2 years, so it doesn't really, you couldn't really see it on this chart, but yield comes down here. That means the price of the bond went up. So you originally locked in a 10% rate of return for 2 years. But as the yield comes down, you could sell that bond and make a lot of money because yield went from 10 to, say, 8. So what is that, a 25% move? If you sold the bond, you would have given up your 10% rate of return, but it's somewhere in there. If you'd sold the bond down here, you would have been getting that 10% over this time, and then you would have gotten the capital gains of the bond itself. So if you forward that to today, yield has gone way up since the bottom in 2020, right? If you buy a 2-year bond at 4.87 is where we are right now. If yield comes down, the price of the bond goes up. So where with a CD, you're guaranteed to get that, 4.87%, but you're not going to get any of the capital gains if the yield comes down and the price of the bond goes up. So if I was looking at it, it's easier to buy CDs. It's less confusing. But what people that are what retail investors really that are using bond ladders right now, if you buy this bond, 2-year bond at 4.87%, and then the market, the Fed breaks something in the economy, the stock market starts tanking, and the Fed has to quickly lower interest rates. So the Fed comes down and brings rates back down to 2%. The value of that bond that you bought here is going to double in price. So you can get, while you're waiting for that to happen, you're getting that 4.87 rate of return. And then if and when this does happen, you sell the bond down here and you've doubled your money. Does that make sense? So
I mean, it does to me.
Yeah. It's obviously much trickier than, just moving in and out of the stock
It's why people
funds,
that do, fixed income, right? That's the right term?
Fixed income, yeah.
People that do fixed income, that's all they do.
Yeah.
And a lot of people look at that as kind of boring, right? But you have to really know it's a whole different game, right? Being able to manage bonds the way you were just describing, you have to have a really good understanding of what the bond market does. And that's where I've always, like, when you go back and think about the whole 60-40, thing that a lot of people will use as an example of what a financial planner would do for you, being 6% equities and 40% bonds. If you were actively managing your bonds, that 60-40 split isn't that big of a deal. right? But that's not normally how it goes, right? They're not actively managing anything.
Right.
They're just going, here you go. We're going to put you in mid caps, and we're going to do,
A bond fund, the F fund,
bond funds,
Yep.
and call it a day. That's not going to work. So it's not to say that the 60-40 split wouldn't work. It definitely does work. As a matter of fact, most people, high net worth, big money, their portfolio is balanced like that, right? But they're also actively managing all of it.
Right.
That's the difference, and that's the part that we're not doing. We meaning the average retail investor.
Right.
We are because we know better.
Right. Honestly, if you watch, we haven't talked about Wealthion in a while, but
yeah, that's a great one.
It's really good because so Wealthion's YouTube channel. This Lance Roberts is a guest every weekend on Wealthion, and he goes over. He's a money manager, and he has an RIA in Dallas, I think, and he explains what his funds are all 60-40, but what he does is actively manage the 40% on the bond side. So he'll do these bond ladders when, because sometimes it's better to be in 2 years or shorter treasuries, and sometimes it's better to be in long treasuries, right? And so he'll actively manage the bond side and actively manage the stock side. And so if you want to get an understanding, I mean, it's worth it. They post it at 11 o'clock every morning, East Coast time on Saturday morning, and it's a really good weekly recap. And over time, you get the idea of what they do at it's called realinvestmentadvice.com. I'm pretty sure is his website.
And it's not only that they're actively managing. That's what we would be on that side, right? But they are also actively managing the tax implications,
right?
Because that's not only the tax implications, but just like in general, the fees that go along with making all this happen. So if you move your client's money too much, you're gonna eat away at your returns because of all the cost it costs to do that. And so you got to balance that. You also got to balance the tax implications for the person, and so you got to know what their person's situation. Right. So it's really complicated, and that's why it's not easy.
No.
And it's also why we tend to stay away from all of that and focus on retirement accounts, because it is simpler, but it also there's a lot less things to juggle, particularly in TSP, right? We're not dealing with any tax implications. We're not dealing with any personal circumstances. No. It's the market's doing what the market's doing, and this is the best trend to take advantage of at any given time in the TSP.
Yeah. Yep. Okay. Bonus chart, Tesla. Tesla gave me a really good opportunity to go back and talk about Elliott waves. So
I'm sure they did that on purpose.
I'm sure they did. Actually, one of our friends asked me a long time ago. Let me see if I can see. Was it 2021? When did I retire? 2021. I think it was here. Can you see that? He asked me, he was looking at selling Tesla in here somewhere. And I'm like, oh, no. Absolutely not, buy more. And he's like, why do you say buy more? I'm like, because, and I just drew a quick Elliott wave chart for him. I'm like, this is a big 1 move up, a 2 down. This is part of a 3 leg, and it's only going higher from there. And finally, the 3 finished. We got a ABC 4 and topped out at a 5. So I don't know if he stayed in and weathered this part or what, but I retired and I'm long gone. Anyway, so we go back. This is a weekly view of Tesla going. Their last major low is back here in the middle of 2019. It's a logarithmic scale, right? So you can see on the side here, they're not going up sequentially by number. It's logarithmic. So in terms of Elliott waves, you got a 1, 2, 3, 4, 5, and had a top, right? And then the 2 wave is ABC for an A, B. This is actually 1, 2, 3, 4, 5 for a C, which is great. So now we're down to a C. So what that means is this is a 1, 2. So the next move is a 3. and the one leg went from the middle of 2019 to the middle of 2021. So the 3 leg should be years and years. And if Tesla is a lot more than just a car company and all that. So this is a great opportunity for people in Tesla in the big scheme of things, because you got a long-term 1 and a long-term 2, and we're just beginning this long-term 3. All right. So that's my base case for Tesla. If you want to look at it on a short term and you zoom into this part right here, this is not logarithmic. This is regular scale. And so we are 2023. This is the bottom right here. This is the bottom right there. Okay. So we go up in a 1, A, B, C for a 2, 1, 2, 3, 4, 5 for a 3. And now we're in this 4th wave. Okay. So the 4 wave should come down to the area of the prior 4, which is right there. And that's where we are right now. Okay. So, and we had a reversal day. Daily or weekly? Daily. So we had a reversal day on Friday. That could be the bottom of that 4 wave. It's possible. Not confirmed yet, but it's possible. We also have this gap that needs to get filled. So I would actually like to see Tesla come down to, what is that, 235-ish, and then break up. So if you drew this downtrend line and Tesla got up here somewhere, I would say that is confirmed and you're going higher in Tesla. It fails if you get below 214, because you can't, the 4 wave can't break into the area of the 1 for an Elliott wave count. So as long as we stay, the 4 wave can come down anywhere. It can't get below, say, 215. If it gets below 215, then the pattern is wrong. But as long as it reverses anywhere in here and goes back up, you're in good shape. So I'm looking for, and this is a good kind of zoomed in from both weekly to daily, and the gap fill, and the line in the sand, and there's a whole bunch of analysis that we just went through. But I'm looking at Tesla as a buying opportunity here.
Yeah, and not only based on those charts, not only does it look like a good short-term buy, right?
Yep.
It looks like a good long-term buy, and depending on what you're trying to accomplish, and this is what I think is really important when folks see this. It doesn't mean that we're definitely not telling you to go buy Tesla. First of all, disclaimer, right? This is a learning tool, right? And he's teaching you Elliott wave. Now, with that said, if you decided to buy it, you need to decide why you're buying it. Am I buying it long-term because I think that, and this is where you would look at fundamental things about the company and also this chart and go, yes, I see all the signs that they're going to continue up for the next year or two. So that would be a good long-term investment, meaning you're not having to worry about short-term capital gain issues, right? Because if you're in and out trying to play this thing like a day trader, most day traders do not tell you. They tell you their returns. They do not tell you how much money they actually made. Right.
Big
After
difference.
all of it's done, how much you actually made out of all that trading, right? It's a lot like gambling. Every gambler likes to tell you about the 20 grand they won, but they don't tell you about all the other little losses or whatever. You get the analogy. So where I'm going with this is deciding why you're buying it. So am I buying it short term? Am I buying it long term? What are my goals out of this? And also, don't take your eyes off of it, because that doesn't mean it's exactly what's going to happen. Right. So you got to have a get out point. What's your get out point, right? You have to have your plan A and your plan B, right? So have your lines in the sand both ways, right? Like Jerry was pointing out, if it breaks through this, I'm not just going to sit and hope. Right. Getting out. Right. It didn't follow the pattern. Right. So, it's a great learning tool when you can see that play out. And what'll be interesting is, hopefully we come back like in a year and we look at Tesla. I'm sure we'll look at Tesla again and see how that, Elliott wave pattern played out. I always think that's fun because it's like, even if I didn't invest in that thing, it's like, oh, well, it really did happen.
Yep.
And because these patterns are just people's behavior, and there's patterns within it, right? And they've proven it,
Absolutely.
and it works. So anyway.
All right. So that's it for Tesla. TSP fund charts. So let's see. We wanted to go back. This is basically a 3-year, a little bit more than 3-year weekly chart. This is the low from COVID. And before we were talking about how you have to be willing to accept, this is a weekly chart, okay? So every time price got back above that 20-week moving average line, any little correction came down and found support at that 20-week moving average line, right? So over time, over the course of 2020, second half of 2020, all through 21 to the beginning of 22, price moved up a lot, right? This is a big percentage move in price. But it doesn't go up in a straight line. We get these pullbacks, but every time we got them, they pulled back to that 20-week moving average line, right? Until it broke through. Okay? So this was like the buy trigger when we got above there and RSI got above 50 and MACD had crossed positive. That was the buy trigger. And we talked about this whole thing last week on the show. The sell trigger was when price broke down below the 20-week moving average line. RSI got below 50 and MACD had already turned negative. And then the buy trigger over here, there was we had a buy trigger in here that we would have taken a little bit of a loss on, and you can look at that in last week's show. But once we got above the 20-week here, RSI got above 50, MACD crossed positive, you would have been in this 2023 rally. Actually, let me go back. It was actually November of last year. It was this one. Anyway, the point is, if this is a major low, right, then this is a new bull market. If that's the assumption, then price should act like this. And on the pullbacks, we should get support at that 20-week moving average line. So you have to allow price to come down to the 20-week moving average line. And that's where the angst comes from. Because from here to here, doesn't look like a whole lot on this chart, but it can be the $10,000 that question was about. And so this is how you use technical analysis to do it. If you want to be in on these upswings, you have to be willing to stomach the pullbacks to the support level, so that you can make a decision at that point. And unfortunately, with only 2 moves a month, weekly is the best way to do it. And if you get out anywhere in here, the question is, when do you get back in? That always has to be the second question anyway. As soon as you make a decision that you're going to reallocate, say, to the G fund, the next thing has to be, okay, when will I know it's time to get back into the stock funds? And let's say you got out last week, right? And price never gets back down here, right? What if it keeps moving higher? What if next week we have an up week? The week after that, we're at new highs, new relative highs. When would you get back in? Right? That's the problem. Is when to get out and when to get in. It could have been anywhere in these weeks, these down weeks. You could have said, well, the market's rolling over, I'm getting out. And then when would you get back in? That's the problem. That's why the rules are there. We're nowhere near the 50 RSI line right now. MACD is nowhere near crossing to the downside. Is it painful to take 2 weeks in a row of losses? Yes. Am I saying that the market is not going to roll over and crash through? Nope, I don't know yet. If it breaks down below that 20-week moving average line, breaks below 50 RSI, and MACD turns negative, that's it. You're out on a weekly basis, just like it would have been right there. We're not trying to catch the tops and the bottoms. We're trying to catch the 80% in the middle. S fund, same kind of thing. This is actually, yes, you don't want to take these 2 down weeks in a row, but the closer it gets to that 20-week moving average line, the closer we are to an actual decision point, which will be great because we won't have to roll our hands around about it. We're still at support there at the moving average of the RSI, and MACD definitely is not rolling over. So, yep, 2 down weeks on the S fund, but certainly no sell trigger. I fund. How many times have we seen the I fund get support at that 20-week moving average line? And that's where we are right now. And support at 50 RSI, right? We don't have a sell trigger on the I fund on a weekly basis. Can it break down next week and we get a weekly close down here somewhere and RSI, is down here at 40? Yeah, that could happen. And that would be our trigger that it's time to get out. But until then, this trend is up. It's volatile, but it's up. F fund is a completely different story, right? Hopefully you guys can see the huge distinction here, right? We've been talking about this one for months. Here was the top in the F fund back in 2020. We had a 1, 2, 3, 4, and we're in this 5th wave down. When we get down here, I don't know where here is going to be, but when we get down here, it's going to be a great buying opportunity for the F fund, but we're definitely not there yet. And I was saying that the F fund kind of corresponds to what we're talking about in yield. When yield goes up, the price of the bonds goes down, right? So as yield has been rising, the F fund has been declining. And as long as yield keeps going up, the F fund keeps going down. So what ideally happens is the Fed keeps raising rates, yields keep going up, bond yields keep going up, price comes down on the F fund. At some point, the yield, because as price goes down, yield is going up, right? At some point, yield gets so high, your mortgage payments are higher, your credit card loans are higher. You want to buy a car, it's 14% to get a car loan. The economy can't take it. So the Fed has to cut yields, cut the Fed funds rate. That makes yields fall, and the F fund price explodes to the upside. Right? It's almost definitely going to happen. It's just a matter of
don't know when.
When?
Yeah.
So like I said, we've been talking about this for months, and I do think the F fund has lower to go. But once it gets down here to start testing, say at 93, so like a double bottom, that's kind of the time where you would really want to start looking. And if we get oversold like this down here somewhere, and we got down here at like 75, and we were way oversold on RSI, that would be the perfect time to get back into the F fund. But we'll be following it very closely. Questions?
As we always do.
As we do.
Questions. If you have questions, as always, put them in the comment section wherever you find this video. And if there's no comment section, you can always shoot us an email at info@growmytsp.com. I was getting ready to say
support.
A different one. It's
support,
not
that one
info.
too. Not info.
Not
support.
info. Info is not monitored. I knew I was going to make that mistake. That's why my brain wasn't working. Support@growmytsp.com, and support will forward that on over to us, just like they did that email that we, discussed.
The
earlier.
questions are great. Obviously, we don't put people's names on the questions and stuff, and if you guys ask us questions, then we know what people are interested in talking about.
Absolutely, yeah. And this whole thing is about learning, and we want you to learn. And if you subscribe to our newsletter, you get way more way deeper level of analysis that helps you make decisions on how to manage this, right? Yep. So when you see us talk about the weekly charts and everything, we go into daily charts, and and Jerry does a walkthrough, and that information is to give you enough analysis that you can make your own decisions on how to actively manage your TSP. And we love doing it. Yeah. So keep sending some questions and give us stuff to talk about. And hope you guys have a great week, and we will see you later.
Later.